A lot of people in this audience may have a long-term view, but few take it as far as the team at Ariel, whose symbol is the turtle, and whose theme is slow and steady wins the race. Rupal is one of the rare breed of value managers who has outperformed her benchmarks over the last 2 decades. She credits that to her uncommon investment success, to the process, looking at non-consensus investing and long-term thinking. Not surprising that Barron's has called her global contrarian, and Forbes has called her a global guru. So I think you'll enjoy hearing about the power and the payoff of long-term thinking investing from Rupal Bhansali. Rupal.
Thank you. Thank you. How many CEOs in the room? All right, all right. You're definitely going to find what I say unconventional. And how many investors, i.e. actually people who do equity research and manage money in the room? All right. And then people who do asset allocation, they actually give other people money to manage and oversee them. All right, so we have a fair mix of audience here. And hopefully we are just about to start. Wonderful, thank you. So, any presentation in America starts with this slide. I'll consider this as read. So, the holy grail of investing is to be in the northwest quadrant, which is, Seattle as opposed to Miami. Higher returns on the x-axis and, the volatility of that return. So the red dot is my performance, and the black square is the benchmark, and obviously we've beaten both. And the interesting thing is we've done it, of course, in 2 very different market environments. Now, I've done it earlier in my career too, but this is all I can show you. So take my word for it. 2001 to 2011, that's my former employer, and that's my track record there. 8.5% returns compared to 5.5 odd for the benchmark. So clearly about, a couple of 100 basis points of outperformance. And then more recently at Ariel, where I've spent the last 5.5 years, a similar sort of pattern. Now, the markets are completely different, right, in that period. And that active has underperformed pretty much during this period, if not that one. And that value has underperformed even more. And I'm all of them. So it begs the question, what do I do differently that allows for these outcomes? And that's kind of what I'm going to share with you, the secrets of this kind of outcome. But before we do that, let's look at a thought experiment. You're all used to looking at performance numbers, and they typically, conventionally, are read off in this way. What did your portfolio do, the column 1, year by year, and what did the benchmark do, right? That's what we all see. And if you look at this manager, what you'll find is that this manager has only outperformed in the years that are shaded green. And that's just 4 out of the 10 years, right? In the blue shaded section, it's all the underperformance. So imagine this is a success rate of this investor measured by frequency, AKA short-term measurement, year by year. This is the record of the manager. And if you looked at this record, you'd say, fire this manager, right? Fire this manager. What a bad batting average. Look at this record. And then if I told you, and remember the title of this is a matter of perspective, it's how you look at it. I'm going to show you the same data with another data point. Look at what happens here. Look at the net number there. The net number there, for those who can't read, is it's 8.9% for this manager who has only outperformed in 4 out of the 10 years, and the benchmark is only up 5. And you say, how is that possible? How is it possible that with that kind of frequency of performance, where this manager completely ignores what he or she enjoys in terms of performance in the short run, but in the long run gets you to the destination? How is it possible? How does this performance record occur where you have 360 basis points of annualized outperformance? Trust me, there is no typo. This is audited. This is why. If you now look at performance unconventionally, what you'll find is column C and column D, same numbers. The $100 with this manager declined only 6% and 2% when the benchmark, you remember the dark days of 01 and 02, markets were down double digits. So the benchmark declines from $100 to $72, whereas this manager only goes down 92. Such that even though the manager only goes up 35% when the benchmark is up 39, This manager is delivering 24% capital appreciation because you're starting from a higher base. And then it continues, and the reason I highlighted this section in yellow is because it's the year 2007, and it was the high water mark of the bull market of that cycle. And look at what happens even at the peak of the bull market. This long-term approach to investing still pays off, where 226 exceeds 190. That's just a fact. And look at what happens even in 08, and the only reason I call it 2008 is it was the dark day of the market in that decade. And this manager loses much less, 24% compared to 43, which outcome in terms of growth of $100, cumulative performance, which is ultimately what you care about, is your pension plan funded, not funded? Is your retirement account positive or not? Can I pay bills with that money or not? At the worst point of the equity market cycle, this manager has delivered 71% capital appreciation, right? That's absolute dollars. The benchmark 8. You were better off putting your money in a CD. So how is this happening? This is the power of patient investing, and this is the way the arithmetic works. What people forget to realize is you always lose from a higher number. Market goes up, you're losing from that higher number, always. And when you go up, you're always going up from a lower number, definitionally. And so think about it. If you had $100 and you lost 50%, you're at $50, right? Imagine if you're only up 50%. You now are only at $75 because you went up 50 on 50. You need to go up 2x, 100% from 50. And to add insult to injury, even if you found an idea that could go up 100% and it's hard to find, you're only at break even. So the message here is try not to lose the money in the first place. So avoiding losers is more important than picking the winners. Anyway, same thing applies in the corporate world. So that was for investors because I wanted to show you that measuring frequency, measuring short-term performance itself, and the way we measure it itself is so flawed. It is a matter of perspective. This is the way long-term numbers play out. Look at this chart here, which is a white paper done by McKinsey and Harvard Business School, and it's sourced here, so if you want it, you can look it up. The blue line is corporate performance, and these are the companies that have a long-term orientation, and it's explained in that paper, so I won't go into all the details. And the one in the gray is, look, during the gaga days, the blue line, these companies underperform, so to speak, right? Their revenues are doing worse than other people who are probably taking on more risk, and in the short run, they look like they're very smart. But looking smart and being smart is two different things. Look what happens after the crisis. This is the power of patient long-term investing. You want to lose the battle and win the war. We keep forgetting that. That's what it's about. And I just wanted to show you it's true of earnings, it's true of economic profits, it's true of market cap on all the metrics that you can sort of look at this data. So let's now understand what's happening, because if a man from Mars came to Earth, this is what they'd find, and they'd be shocked, because I am shocked when I read this. But this is what's happening now, right? This is my version of the new normal. The strongest companies are the most vulnerable. I mean, it's bizarre. Microsoft, Apple, GE, Nestle have activist investors. Seriously. Since when did that happen to us? How did we let this happen to us? The tail keeps wagging the dog. Corporate CEOs are supposed to think about their business, not their share prices, and yet it's sort of, everybody's looking at their share price. Why? Because it's visible. It's right out there. And every day you get a ticker that you can look at. And so everybody's focusing on how the share price is doing as opposed to how the strategy is doing. And I mean everybody. I'm not excluding anybody here. We are all guilty of this. Present company accepted, of course. Squeaky wheels get the most oil. I must confess to you, I never realized this till one day, CEOs would come up to me and say, well, on these quarterly calls, you guys ask such short-term questions, I'm supposed to answer what happened in the quarter, and I'm like, but I'm never on those calls. And that's when I realized that the people who are on those calls are the news media and the sell-side analysts and the short-term investors who care about what's happened in the quarter, the hedge fund guys, whatever. I am not. And so that vocal minority seems to drown us out and we never get heard. And our point of view is, I actually don't want to bug you. I don't want to waste your time. I don't need that quarterly call. But that never comes out. But it does now that this forum has been hosted. But that's what's going on. And we are all guilty of this. We should know better that what we are running is a marathon. It is not a sprint. And what it takes to succeed in a marathon is to pace yourself, not race yourself. Speed is not what it's about. In fact, if you try to run too fast in a marathon, you will lose it. You're guaranteed to lose it. So if we are misunderstanding the nature of the ask, whether it's investing or it's managing money or it's running a business, that's what we are doing. And I will tell you, this is the statement for all of us to file away. And the reason I talked about, the victim being the perpetrator, we are doing this to ourselves. Do you know why? Because I can sit here on the other side, and I've heard CEOs say too, I think this was one of the forums hosted by CECP, where CEOs were talking, and there was an asset allocator, and a very big one, and the asset allocator was going all this platitude stuff, oh, we are very long term, and we're very long term, and I don't know why you'll think we are short term. And the CEO stood up and said, well, with all due respect, when I don't do well in a quarterly earnings call, you guys are all over me. And that's how the CEOs feel. Because they are supposed to come in front of us in a public forum, and it's all out there. What the same CEOs don't realize is their corporate pension plans are doing exactly the same thing to us. It just happens in a private meeting. They call us in and they say, you underperformed for the quarter, you underperformed the last year, you're on a watch list. And so this is what I mean by what goes around comes around. Look at ourselves. The right hand doesn't know what the left hand is doing. We are actually doing this to ourselves. So till we don't change that on both sides, this is going to persist. So let's not hold anybody else accountable. It's all us. So what do? Control the narrative. That is in our hands to do. Control the narrative, control the agenda. We can't let someone else hijack what is the biggest mission for all of us because the stakes are too high. Nobody tells us to aim for heady growth. Since when did that become the only marker of success? Steady is just fine, thank you very much. You don't have to manage earnings, you have to manage expectations. Both you and I, as an investor and as a manager. Who said you have to manage quarterly earnings? I want you to manage earnings power, staying power. Big difference. That's what investors care about. You know why? Because if there's one fact that we all know is in the long run, and I know the long run feels like an eternity, and it's not Keynesian, we all won't be dead, trust me. We have very long lives to live. If we don't understand that if we ourselves let ourselves be victimized by this narrative that we have to discuss quarterly earnings, that we have to focus on quarterly performance, I don't, and I should be unsuccessful, right, by that logic. But I'm not, because I don't accept that status quo, and neither do you. Nobody tells you that you have to do that. Just change the narrative. Let the chips fall where they may. Discuss what you have to discuss, which is your vision, your execution, your scorecards, your whatever it is that you want to discuss. There is no need for you to worry about whether there's a sell rating on your buy rating, whether your stock price is up, it's down. Just figure out what you're good at doing, which is running the company, and just do that. And then go against the grain. I know this is very hard because you've got activist shareholders nipping at your feet, with, if you have a high cash balance, watch out because they want you to, do a big share buyback, right? The easy financial engineering trick of the day, I'm told. And, if you have created, certain business lines which require R&D investment that have a long-term payoff and they're not generating money today, well, go sell it, right? Because I want my earnings today. And I understand that those pressures exist, but you know what? There aren't so many activist investors around. There are thousands of you. How many of them will they come after anyway? And they have Microsoft and Apple to go after. You can't keep worrying about, everybody's approval ratings, seriously. And we've got to grow up and say, you know what? Let the activist come. If I've done the right thing, what are they going to tell me to do that's different anyway? And, the activists tried that on American Express. The activists tried that right now on Nestle. They tried it in Fanuc in Japan. And I'm just trying to tell you, this is a global phenomenon. It's not just US. And all these companies deal with it. So why in America there is this concern that suddenly activism is unique and it's a pain point for us to solve? I don't understand. It's because we are making it so, because it's in the headlines and we are all looking at the news and watching the news and it's out there flashing. There are 1,000 companies in this country and most of them don't have activist shareholders and they won't anywhere near get near them. So give up this ghost, stop fighting these pipsqueak battles, even though they're very large, because they're really pipsqueak. We give them more attention than they deserve. And the real investors, who are constantly fighting this epic battle in the marketplace, where the right share price is discovered by the right kind of research, that's the investor you want to focus on. That's the one who matters. So I'm telling you to go against the grain, which is, look, in a bull market, people never see a bear market coming. I was standing in front of a couple of CEOs from Germany once in January 2008. And all of them, it so happened, that was a quarter, that was a month where stocks had just swooned. And every CEO stood in front of me and said, and many other investors, I'm sorry, it was a conference, and we don't understand why our share price is going down, and business looks great, and we don't understand, and we're going to buy back our stock, and et cetera, et cetera. And we all know what happened in 2008. They were completely and utterly wrong. They didn't see it coming, the market saw it coming. Which is another reason why I tell CEOs, don't look at your share prices, because you clearly don't know how to look at them. If investors don't, who are you? Seriously. But topic for another day. My larger message is don't look at the share price. In the short run, it's inefficient, but by design. Markets are not supposed to be efficient every day and all the time. But they get there over time. But by fixating, it's like watching your blood pressure. The more you watch it, the more it goes up. Like if you stop watching it, it's actually a pretty good outcome for you. Okay, so build defense in the good times. Cash is good. Cash is not a 4-letter word. Debt is a 4-letter word, as Toys R Us discovered this morning. And I'll leave it at that. Measure what matters. As I told you, if you start measuring your quarterly performance and your annual performance, like most investors do, asset allocators do, company managements do, you're missing the point. You have to judge cumulative performance. It's over a period of time because short-term pain is required for long-term gain. And if you keep penalizing short-term pain, you will never get the long-term gain. We leave too much money on the table by trying to avoid every bit of volatility in the short run. In our life, we make sacrifices all the time. We ask our kids to. Why don't we do that with our core job that we are paid and we collect a paycheck for? Again, lose the battle, win the war. So, my final message here is, I don't know who sent out this memo because I haven't read it, but apparently all CEOs have gotten this memo, and I'm here to tell you there is no such memo. It is in your imagination that suddenly speed has become the barometer of success. It is not. It's compounding business worth. That is the job of the CEO. Generating the most amount, the highest quality for the longest time of free cash flows in the business. That's your job. Just do that. It is my job to make sure that the stock price converges to the business worth that you create. And if I don't, it's my loss, not yours. So let's have a division of labor. You do what you're good at, law of competitive advantage, right? Run the business. Let me figure out what the fair price is. And believe me, we are all in this as investors to make money. If there is a mispriced investment opportunity, we will find it. So let us do our job and do your job. And that's all I had to say today. Thank you.